My name is Emma. Head up the employment team at Thackray Williams Solicitors. For those of you that don't know Thackray Williams, we're a law firm. We have offices in Bromley, the City of London, Sevenoaks and West Wickham. I'm really pleased to be here today with Paul Andrews, a director of Corinthian, who is about to expertly take us through the social care funding proposals. Paul's already laughing. Paul and I were speaking probably just over a week and a half ago now. Actually, we're both business owners, as well as being sort of a lawyer and a financial professional. We were both sort of talking about the various squeezes that we're all experiencing as business owners at the moment, and we both feel that the social care funding proposals really kind of brings a lot of those issues into sharp focus. So what we're going to do today, Paul is going to, like I say, expertly take us through these proposals and the sort of steps you can take to kind of mitigate and reduce the impact that has on employees' take home. And then at the end, if we have got time, we're going to look at some of those other issues that are really kind of coming into the fore. We would really like today to be pretty informal. It's an open, I understand it's called an open Zoom, which means that people can take themselves off mute and share any experiences they've got or ask any questions. If you don't want to put yourself on the spot, then you can equally type them in and Paul and I will answer those questions as we can. I suppose the only rule of today is no heckling. But without further ado, I'm going to pass you on to Paul. Thanks, Paul.
Hi, thanks, Emma. And good morning, everyone. Thanks for attending this morning. Really appreciate it. I'm Paul Andrews. I'm a director at Corinthian Benefits. Just a bit of background. I've worked in the financial service industry since 1987. Initially, I was providing advice to individuals, but for the last 20 plus years, I've been working purely on the corporate side of things, helping trustees, companies, and just as importantly, their employees. My experience runs across the sort of the whole breadth of employee benefits, probably specialising more though in the pension side of things, both in defined benefit or what you might know as final salary pension schemes and defined contribution, which nowadays obviously a lot of us refer to as workplace pensions. At Corinthian, our aim is to make the complex simple, which isn't always as easy as it sounds. But this year, we've been nominated for 3 Corporate Advisor Awards, which for our industry is a bit like an Oscar. So we've been nominated for Corporate Advisor of the Year, Best Pensions Advisor, and Best Health and Wellbeing Solution. We also work with ISBA, so the Independent School Bursars Associations, and we're helping both teaching and non-teaching staff with their retirement plans. So enough about me. If we sort of look at the agenda for today, as Emma's already said, there's quite a few things that we're looking to go through. So hopefully we can cover these off. There might be questions that you've got as we go along, as we've said, if you can sort of hold those and park them and put them in the chat as we go, and we can pick all those up at the end. So first things first, I suppose, obviously, yeah, the Prime Minister announced, as we all know, a 1.25% HCS levy, which comes into effect from April 22. These changes are estimated to raise about £12 billion a year. And we've been told it will be ring-fenced for health and social care costs. I think that is potentially one reason why it's at the moment being done separately to income tax, because those taxes go to different places. And whilst this might appear negative, I think there are some positives to this. You know, if we sort of think as retirement ages continues to increase, as we know, it used to be 60 for females, 60 for males. We're now at a situation now where it's 66 at the moment, and very soon we're moving to 67 and 68. So with that increase, individuals are focusing on how they can fund their retirement costs. And with a lot of people, there is a concern about the cost of social care. So perhaps now with also, when this came in, there was also a proposed cap on social care being put in there as well, of a lifetime cap of £86,000. Together with some more generous means testing limits, which there are still some bits and pieces that have got to be finalised on that before we can talk to people as to how secure those are. But initially, in April 2022, next year, when the levy is added to national insurance, I think, again, I think it's been put on national insurance temporarily just because of a speedy implementation of this. But this national insurance rate means it's going to apply to any earned income. So that's going to be things like salaries, and profits for self-employed, but not unearned income. So it's not going to relate to pension income, rental income, or investment income. It will also have the same starting thresholds as national insurance, and therefore it's uncapped. But obviously that's going to mean that it will fall obviously on, as we say, employees, employers, and the self-employed as well. Now those starting levels for an I mean it's going to probably apply to more people than it would have done if it was applied to income tax, because it will catch more of the lower earners as well. As we probably know, the income tax threshold got a nil rate band of just over 12,500 this year, and national insurance threshold is under 9,600. So it is going to catch more people than it would have done if it was an income tax. Alongside the new levy that we've seen there, this levy also is going to apply to dividend tax rates as well. So this means that anybody that's got dividend income, so that could be business owners, investors, they'll be making contributions in line with that made by employees and self-employed on earnings. We do have effectively a dividend allowance of £2,000 tax-free each year. But for privately owned businesses, you've got to think that this is now an extra 1.25% levy, and there's also talk, or there's also a move from April 2023 for corporation tax to increase to 25%. So any businesses with profits in excess of 50,000, they might need to start looking at, okay, what are my total profits? Do I need to be speaking to my accountant and actually look at the salary v dividend now? Is that going to be as beneficial as it was? The April following year, so to April 2023, this new levy will become its own tax. So it will be a health and social care levy. So it will be distinguished from national insurance. We'll see it as a separate line on payslips, and also on self-assessment tax returns. And also because of how this levy is going to work, it's also going to apply to people who are actually above state pension age. At the moment, as we know, national insurance isn't paid by people at state pension age, albeit is continued to be paid by employers. But once this levy's got its own tax in 2023, that will actually incur on them as well. Now, additionally, I think when it's actually got its own sort of line on payroll, it is also possible that the thresholds could be adjusted. So that might be adjusted in line with income tax. I don't know. There's nothing I've seen yet to indicate any changes to that. But again, it is something that could happen. But if the threshold does remain unchanged, then it is going to affect those people on low earnings who might not have been exposed to a tax increase, or a tax charge, should I say, until they hit the new sort of 12,570, which got frozen for 3 years at the last budget. So there could be implications there. So if we just take a look, this is a busy slide, so I do apologise on this. This is just really breaking down the thresholds and the tax rates. So if we take the employee line as a way of example, we know that the threshold for paying national insurance is 9,568 for the year. And that's sort of split with a main rate and a higher rate. So the main rate being 12%, higher rate being 2%. So in other words, anybody earning between 9,568 and 50,270 pay 12% national insurance. Then anything above that, the 2% higher rate applies. For employers, so for businesses, there's effectively one rate, which is a flat rate of 13.8%. And that applies from the threshold of anything from 8,840 upwards. I'm not really going to focus on self-employed today. It's mainly really employers and employees. As you can see in 2023, obviously that is just exactly the same. All we've done is it's an extra 1.25% that's getting added to those bands. And then is say in 2023, 2024 tax year, the bands return back to what they were, plus the completely separate health and social care levy will be as a separate item. So as well as national insurance on those, as I mentioned already, we've got the national insurance contributions on dividends. So again, for basic rate taxpayers, high rate taxpayers, and additional rate taxpayers. Again, as I say, no rocket science here. These are just an additional 1.25%. So what are some things that we might want to think about? Okay, dividends, I think. So for SMEs, family-owned businesses, they might want to consider bringing forward any bonus or dividends that they might have been looking to receive. Clearly, obviously, there's cash flow and commercial considerations to look at there, but also with the sort of the pending increase of the corporation tax as well coming. Again, depending where you fall with regards to your profits, there will be effectively a sliding scale as to what that charge will be. But the part that I was going to focus on more today really was the national insurance side of things. Now, I know from a lot of people that are on here at the moment, a lot of you are actually using salary exchange. I am aware of that. But I think if you're not, and if you're not 100% sure what salary exchange is, the revenue call it salary sacrifice. But ultimately, salary exchange is just a revenue approved method for employees to pay pension contributions, but basically brings savings to both the employer and the employee. Now what I've just got a short video, it's only lasts about 30 seconds or so, which I'll just sort of run through, which hopefully you can hear if the sounds actually worked this morning. If not, I'm going to have to apologise in advance.
You have to provide a pension for all your employees. You and your employees have to make contributions every month. But did you know there's a way both and your employees can save money, all approved by HMRC? All of our 360 clients do, simply by using salary exchange. David and Kelly both earn £30,000. Their pension is set up on the auto-enrolment minimum contribution basis. Their employer pays 3% of their pay and they pay 5%. David pays using the automatic basis and the net cost to his take-home pay is £100 a month. Kelly works for a company who offers salary exchange and her net cost is just £85 a month. Which option would your employees want? You can save money too. This can be a significant saving for you every year. Save £207 per annum for each employee who chooses to pay their contributions like Kelly. It is that simple, and the savings for you could be huge. Step 1, call Corinthian Benefits on 0208 189 6100. Step 2, we will come and see you to show you how easy it is. Step 3, we'll do everything else so that you can get on with running your company. Corinthian, for now, for the future.
So hopefully that explains really clearly as to how salary exchange actually works. And if I can move on a little bit, it'll be better. There's just apologies for that. There we go. So obviously I've given you the percentages and the details on there. But you know, what does it actually mean in pounds and pence? So just as per the video example for somebody earning £30,000 a year, if you look at the current tax year from an employee perspective, they'll be paying about £2,450 in national insurance, and a company just over 2,900. But next year, this levy, this increase, is going to give an additional cost to an employee of another £255, and for a business another £264. So it is all starting to add up. So how is salary exchange actually going to help? Well, if we just roll those figures through, that 255 and the 264, as to what the income loss would be for an employee who's not currently using salary exchange as a way to make their pension contributions, then by implementing salary exchange just to the standard contributions of 5% from employees, that's actually going to bring savings to the employee of about £200 in the year, meaning that their yearly income isn't going to go down by 255. It's only going to go down by about £57 a year, or £1 a week. And from a company perspective, it will gain the company effectively £225 in savings. So again, instead of that £264 extra, it's bringing that down to about £39, so about 75p a week. So it is a way of just helping to just sort of ease that burden of tax on people. But I think this is really a sort of about a lot of things, and I'm sort of hoping this is not going to be a perfect storm, because there's so many other things that we need to start thinking about here. If people are taking home less money, there's a freeze on the tax bandings, which we all like to think we're going to be getting salary rises each year. But we're hearing on the news every day at the moment about the cost of fuel, utility bills, food, transport, loads and loads of other things that are actually going up in price. So the maths don't make easy reading, especially for if I look at myself personally. I've sort of benefited lots of years thinking when we've got round to April each year, My initial take-home pay has gone up just because of the changing of thresholds and how that's happened. But this year is going to be somewhat different for everybody. Now, I'm going to really sort of turn the tables. I'm going to put Emma on the spot as well, because that's the financials, and there are some decent savings there. But I think a lot of the things really that Emma's involved with, these are things that are costing us as businesses thousands of pounds. If we get it wrong, it can be a lot. It can be a big, massive cost and big implications and real legal issues. So I put together a few questions that I hope you don't mind, Emma, but if you could just talk about some of these, if you would, and how you and your colleagues at Thackray Williams are sort of seeing this and what your clients are actually saying and encountering.
Of course. Thanks, Paul. So I mean, what else is going on? I think us as business owners, employers, or even as employees, people feel like they're being squeezed all over the place at the moment. This month we see the end of furlough, which, as everybody's probably very familiar with now, was the government support scheme to sort of assist employers in paying employees, their staff, their salary during the kind of outset of the pandemic. So that was a temporary measure, and then 18 months later, we're finally seeing the conclusion of that. So for business owners, the furlough ends, and you have to make the decision: are you bringing your staff back to work, or are you making redundancies? I think for most of our commercial clients, actually, they've already sort of made those decisions. They're already communicating and bringing people back. We've had the flexible furlough scheme, so people have been sort of gradually being brought back, and we saw the tapering of the furlough scheme as well. But kind of getting employees back into the workplace and kind of the emergence of hybrid working, which is a really kind of hot topic at the moment. This is something that Paul and I were talking about, is that it's, as business owners, we're used to having our staff around us. We like having our staff around us. There's this kind of presenteeism that lots of business owners like to see. But actually, that's more money for our staff. Our employees are now having to find the commute cost again. And whilst they were doing that 2 years ago, you easily kind of spend the money that you've saved previously. So like Paul was just saying, that there's that squeeze on, you only need to kind of open any newspaper this morning is telling you that people are having to choose between putting their heating on this winter or food. And then on top of that, us as business owners, we want to get our staff back in the workplace. So they're now finding the commuting cost. So I suppose, how is that translating? How's that translating for employees and employees? Well, the knock-on effect is that employees need to be paid more. It's not even that they want to be paid more, they need to be paid more. The Bank of England released some statistics a couple of weeks ago, which said that at the end of furlough leave, they expect there to be just a small increase in unemployment, which is fantastic. But alongside that, there's over 1 million job vacancies at the moment, which means there's real mobility in the job market. People are moving around, and therefore employers really need to be able to kind of retain their staff, because alongside the kind of the financials that Paul was just talking about, people and businesses, and Thackray Williams included, are kind of really hemorrhaging money on recruitment. Recruiting new staff is a huge expense in itself, but actually beyond that, it's losing the efficiencies of staff walking out the door, bringing new people in and training them up. Like I say, we have seen this kind of emergence of hybrid working. We also saw yesterday in the newspapers, and we're expecting some announcements today about them amending the flexible working request. So at the moment, you have to be employed for 6 months for a flexible working request. And Paul and I had an interesting discussion on this earlier. But actually, they're talking about bringing that forward so that people can make flexible working requests at the outset. And that lots of the trade unions are jumping up and down and saying that's not good enough. We expect employers not only to offer flexible working from day one, but to advertise the role on how people can work flexibly, which for businesses sort of surfacing from the hopefully from the end or coming out of the pandemic, it's another pressure. So yeah, I mean, I don't know if anybody else on the call has had any kind of experiences of feeling that pressure, but please feel free to kind of share those or ask any questions if you've got them.
Thanks very much, Emma. Appreciate that. So really, that was as much as we were planning to sort of cover as giving sort of information out. A lot of this is what we were hoping for was for you guys, if you've got any questions of your own. I don't know if I can't actually see any questions that have been coming through, but James may be able to. Or if any of you would like to ask any questions for either myself or Emma, and if we can, we can try to answer those.
Actually, Paul, I've got one from one of my clients that couldn't come along today. They wanted to know whether the salary sacrifice could, or salary exchange, should I say, whether or not that could be applied to directors of businesses.
Okay, yeah, well, I didn't cover that. Actually, yeah, I've probably just assumed that it would be no, but yeah, good question. Yes, absolutely. Obviously, it's going to depend how much the director is actually taking as an income level. If they're taking substantial amounts in dividends as opposed to salary, then we'd have to have a look at that, because clearly we don't want to be taking people below the actual threshold, because we want to be in a position where they're still getting credit for the likes of state benefits. But yes, income permitting, they can actually use salary exchange as a way to make their contributions. Interestingly, what we do find sometimes as well, which is completely outside of salary exchange, we have actually seen a lot of directors who pay higher than the standard rate of tax, but haven't actually been claiming back their higher rate tax relief, which is quite, it can be quite substantial amounts sometimes.
Thank you. Did anyone else have any other questions for Paul or myself?
Has any questions come through on the board, James?
Hi guys. No, we've got a quiet group, I'm afraid. I mean, this is your opportunity to obviously speak to some experts and get some free advice if you have any questions. Otherwise, we might have to just wrap it up.
I can see one hand up, Paul Baker.
Yeah. Just a quick thought that's come to mind. I suppose in the old days, if you were sort of approached by an employee for a flexible working request, you could have gone for the trial period, perhaps agree something for 3 months, and then both parties review. With such things now being encouraged to be advertised from the outset, how does the trial period now sit?
Well, I mean, at the moment, that's just a proposal. But yeah, I mean, that does throw into question the trial period. At the moment, it's just a right to request flexible working. And I always say this to employees or employers, that people think that because they've got a statutory entitlement to make the request, they can work flexibly, and that's not the case. So at the moment, as long as you can present a business reason why that doesn't work, then you can turn down the flexible working request, and you've got a fairly long period. There's sort of a 3-month period in which you have to go through the process and conclude that. But actually, if these proposals come through, you're absolutely right, Paul, it kind of throws it all up in the air. And that if you're sort of offering these opportunities to work flexibly and how it might work, that's you essentially accepting that it works for your business. So you're right, you could well see the kind of the end of trial working. But I think this still does have to work for employers. And what Paul and I have been saying when we've been sort of chatting, it does very much feel like everything's been slightly tipped in the employees' favour. Certainly business owners are feeling like that at the moment, in that it's their market. They can move, they can make these applications, and we've had the case study, haven't we? So we've had sort of 18 months where people have worked very successfully from home. So it makes it far harder for employers to say no when a flexible working application comes in on business grounds, when we've been forced to make it work. So it's definitely kind of difficult times.
On the subject of that point, though, would part of the counter argument be that over the past 18 months, perhaps the demands on some of the businesses haven't been how they normally would? I mean, like their customers haven't been making contact in the way that they normally would, etc.
Yeah, I mean, actually, I was hearing about a client actually just today that they've got this flexible working application kind of sat in pools at the moment, and the individual isn't performing, and the individual saying, I want to work from home, and the business is saying, but you're not performing. So let's go through that performance improvements. And once you sort of hit what we expect you to hit in terms of criteria, then we'll reconsider it. And that's perfectly reasonable. You need to come in and perform your job roles. And for some individuals, working from home just doesn't work particularly well. So that's a really good business reason as well.
Can I just jump in, Emma? Let me just do my video as well. Yeah, hi. Just with regards to obviously home working, we've got some people who continue to work from home, and they've articulated that they're concerned coming in due to COVID, not because they're worried about being in the office, it's more the commute to and from. So we understand that, and obviously it's still very it's just still a very disruptive time, isn't it, generally with COVID and such. So we support that. But my concern moving forward is if people do request flexible working, what does that look like in terms of their working, sort of their home self-assessment of their working areas? We've obviously done those throughout COVID. We check in every 3 months. We've made sure that if they need office equipment and things like that, it's been dispatched. But what is our obligation beyond that if they ask for flexi working or indeed to work from home the entire time and they've said, oh, we've demonstrated it? What about what sort of obligation do we have to make sure their office area is as we would have it in the office with
health and safety? Yeah.
And if they don't have space to do that, are they able to then ask for flexible working? Because this has been emergency measures which we've supported to keep people safe. But moving forward, if we know that they don't have that office space, what do we do?
Yeah, that's right. I mean, we've all had staff, haven't we, kind of working out of their bedrooms. The HSC at the beginning, they kind of paused the obligation. So ordinarily, if you've got a home worker, you've still got an obligation to kind of do health and safety assessments. And they originally paused that. I mean, what we're saying at Thackray Williams is that this is a longer term measure. This is no longer temporary. You know, we're already into kind of the 18th month. Yeah. So consulting with all of your employees about their home working environments and what they need. In terms of the contractual position, actually, I have to say we're reviewing a lot of contracts at the moment and turning them into kind of hybrid working contracts. And within those, we're dealing with the kind of health and safety considerations. So it is things like, you know, under the working time regulations, you need to take a break after, 6 hours. You don't know how long an employee is working when they're at home. So you're kind of shifting the obligation back to the employee. So you're recognising it as an employer rather than ignoring it because it's not in your office. Yeah. Shifting back to the employee. That's something that we're rolling out kind of right across our commercial, with all of our commercial staff. So Debbie, we can kind of catch up on that separately, but you're absolutely right. It's the sort of thing that now it's no longer a temporary measure. We do need to be kind of thinking about and making amendments to contracts.
Okay, I might touch base with you separately then, if that's all right. Yeah. I'm thinking of one individual in particular, and I just want to make sure if they are working, like you say, out of their bedroom, for example, as much as we've been able to offer some things, moving forward, if that became more permanent, what that would look like in terms of our obligations to make sure they're safe and they're not, hurting themselves, punched over or anything. Yeah. But equally, if they can't kind of perform properly physically because they're sort of cooped up or whatnot, do we have the right to kind of say, no, we've got to kind of safeguard you and bring you in, because otherwise you could hurt yourself? But I'll talk about that separately. That's sort of, thank you, Emma, appreciate that.
Debbie,